Good morning, everyone. My name is Jason Collins with URL Insurance Group. I'm an annuity and life specialist here at URL, specializing in single premium life, traditional life insurance, annuities, and long-term care. First off, I do want to thank everyone for being on the call today and taking time out of your day. I know everybody has a lot going on their plate, on these nice sunny days. So those of you that are currently doing business with URL, I want to personally thank you. We understand that you have many options as to where to place your business. So that's why we appreciate you working with URL, and we will certainly continue to dedicate ourselves to your success. Those of you that are new to the URL family, I want to welcome you. URL is a full-service, family-owned national broker that has been working with agents like yourself, offering back office support for over 35 years now. Just some things that URL specializes in. Like I said, single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers Medicare Sup and Med Advantage products. So after a moment, if you have any seconds after the webinar, take a quick janner around our website at www.urlinsgroup.com. And like I said, just discover if there's any other avenues that we can help you out with. So today, I'm really excited to introduce Josh Ford with Nationwide. Josh is the Regional Care Matters wholesaler for Nationwide Insurance. A little bit about Nationwide. For those of you that don't know, that have been under a rock, Nationwide offers life insurance and long-term care hybrid solutions for single and joint insureds with guarantees that other carriers just don't or can't offer. You're able to leverage your client's hard-earned money into an even more robust long-term care hybrid solution for your clients. So, today's webinar is going to be a casual conversation regarding planning for long-term care in any market. It's going to be a great presentation because if you've sold long-term care, or tried to sell long-term care, I'm sure you've heard all of the objections. So Josh is here to, help you overcome some of them. If you have any questions with anything, please type them in the chat box. And, as they come in, we'll certainly, get around to them. So without further ado, hey, Josh, how you doing? Happy, what are we at? Tuesday here, right? Happy Tuesday.
Yeah, Tuesday. Almost feels like a Monday.
It kind of does a little bit.
We're on our way through. But I appreciate you having me on the call today, and thanks everyone for joining us. As was mentioned, I'm Josh Ford, long-term care wholesaler here at Nationwide, and I'm happy to come with some content to help you position long-term care, especially in the grander scheme of retirement planning. I know that as Jason mentioned, coming from Nationwide, one of the things that folks don't realize is that Nationwide isn't just the Jingles and Peyton Manning's company, right? We are a end-to-end retirement planning company. We're a very strong financial company. We're Fortune 72, right? So we're pretty high in that 500 ranking. And if you just took our financial side, not the property and casualty, just our financial arm, we'd be about Fortune 120, which is still bigger than things like McDonald's, Starbucks, and a few other brands that you're very comfortable with. So I like to kind of start with that, especially because Jason teed it up so nicely. Nationwide, we're certainly on your side, and we're a very strong competitive financial services company. One of the things, again, that we do is help in long-term care planning. Right now, Nationwide is the #1 long-term care carrier in the industry. And a lot of what we hear is client hesitation. Folks don't understand long-term care. They really find any reason, excuse to not plan for it. So today's conversation is really going to be centered around helping you have better conversations, capture more business, and incorporate more long-term care into your practice. As we kind of go through today's conversation, I certainly encourage you to utilize the chat and the Q&A feature. We'll get to the questions. I'll pause every so often to make sure that we're getting to those. And I want to make sure that today's conversation is just that, not necessarily a presentation, but it's a conversation around effective long-term care planning. And Jason, are you controlling the slides, or am I able to do so?
So you should be able to. You see the little slide? There you go.
Okay.
Yep, you're moving them along.
I missed it. I saw it earlier, and then I didn't see it. There we go. So today's agenda is 5-point. We're going to talk about dealing with reasons that people delay buying long-term care. We're going to deal with the risks of self-funding. And please note, we talk about self-funding, not self-insuring. You can't self-insure. We'll talk about that in detail. And then we'll discuss the value of linked benefit policies, the consequences of waiting to buy, and then how Nationwide can help. I plan to talk for maybe about 20 minutes today, so I do want to leave a lot of time for Q&A and make sure that we have a discussion. But let's jump right into dealing with reasons people delay purchasing LTC. If you have done long-term care in the past, you know that people will delay or deny the need for long-term care in any market, right? So this volatile economies aren't any sort of outlier in that regard, but people are more likely to delay long-term care in a volatile market. In times like earlier this year, where there's some tumult and some ups and downs going on, a lot of clients were hesitant to have that long-term care planning discussion. They didn't really see the value in it, right? Clients would typically say that it's nice to have, but now is not a good time. They would say that we can wait until we're closer to retirement. And we have a few years, we're only 50, we're only 55, we're only 60. We have time. Clients also say that once the market stabilizes, then we'll be in a better position. And we often hear, well, what if I can't afford the premiums? And while some of these points have merit and we understand the client's hesitation, what we counter with or some good questions to ask are, well, what defines a better time? Okay, now's not good. You already let me know that. What's better? All right, give us a timeline for making that decision and having that conversation. When will the portfolio be considered recover? Right, if it's down 10%, when it recovers back to where it was before the volatility, is that a good time? Is there a specific amount of growth that you want to see? That question in and of itself is a really good one because there is no specific point where clients would be comfortable. They don't have a marker. They're just more so almost making an excuse as to why they don't want to have that conversation, but there's really no valid reason behind it. So it can help you have that conversation a little bit better. And the biggest one that I always love is how will waiting to purchase long-term care result in a better outcome? If we waited a year, 2, 3, 5, how is that going to generate a better outcome for you? One of the things with insurance in general is the earlier you get in, the better. Clients are healthier. There are some underwriting when they're younger. Prices are better when they're younger. The policy has more time to grow over time. So how is delaying a year or 2 or 5 going to give you a better outcome than what you have today? Right? A lot of clients just don't think about it in that regard. But what we really want to think about overall is what we're trying to portray is what are the consequences of waiting and what is not being considered when you think about delaying long-term care planning. And the biggest risk, more than anything else, is the risk of self-funding and the plan to self-insure. And you see it in quotes on the screen here. You know, the number one hurdle or the number one thing that clients say to us is that they can self-insure for long-term care. This is especially prevalent with those clients who have $2-3 million plus in assets. They feel like they're in a good place. They feel like they've saved, they've done a good job, and they feel like they can pay for long-term care. First of all, self-insuring is a myth. Again, they're not an insurance company. Neither myself or Jason or your clients or anyone on the call is an insurance company. We can't collectively pool assets. We are not an insurance carrier. So that notion of self-insuring in and of itself is kind of a misnomer. What they're really telling you is that they want to pay dollar for dollar. If they have some sort of expense come up, they don't want to call the insurance company. They don't want the discount. They don't want the leverage. They're planning to pay dollar for dollar for that care, which can be quite expensive. And even if your clients have assets, they have them because they've been smart about retaining them and they've been very selective about what they spend their money on. This long-term care planning conversation is the same. Why pay a nurse, a nursing home, an assisted living facility, a caregiver dollar for dollar, drain down your assets when there is a much better and more efficient way of doing that with some sort of long-term care plan? So a couple more questions that we ask is, will you have enough time to save for an LTC event? Since we don't know when an LTC event is going to occur, clients are unsure. We can't give a definitive answer for that. What rate of return will be earned over the long term? What is your portfolio going to look like when you need long-term care? Which we know the answer to question one is you don't know when care is going to happen. So how can you say that there's going to be a specific return in place? One thing I'll add in here is long-term care planning, especially if you incorporate a long-term care product, they offer guaranteed rates of return. So you would know if you did long-term care planning, you're going to get 8, 9, 10% on a guaranteed basis, regardless of when you need that care. Will an economic period of high inflation hinder the ability to contribute to a self-funded plan? That question is a little more wordy, right? But if the economy doesn't allow you to be able to contribute, what are you going to do, right? And will inflation or slow market recovery leave retirement resources lacking? And this is something that we dealt with during COVID. There's a couple times in the past, and even earlier this year, where clients had plans to fund long-term care in the future, but then there was a market downturn. Their portfolio went down 10%. And whatever monies that they lost during that downturn, that was or could have been their premium, right? So we don't want to delay because we don't know what that future looks like. And can you be certain that there won't be a market crash when funds are needed to pay for long-term care costs? Out of all the questions on this screen, that one is always my favorite, because unfortunately, we have had clients who needed care earlier this year. They had to pull out of their portfolio when it was already down, and they'll never be able to recover those expenses that they paid. We had a lot of clients who needed care during COVID, who had no choice to go on long-term care and hire that caregiver. Not only, again, are they pulling money out during a down market, but they'll never be able to recover from that situation. That throws off the retirement plan for their surviving spouse. If you have a husband and wife, the husband needed care. The wife is left with less sure of a retirement plan. Their legacy plans are also thrown off. Any charitable giving plans that they had, those are almost thrown out the window in some cases. So not having that long-term care plan in place in that mass liquidity event that follows just throws off the entirety of the retirement plan. So the unknowns do not exist when you have a long-term care plan. And that plan can include a long-term care insurance product that helps to pay for that care. So I know we talked about a lot so far. I just want to pause for a second. Jason, are there any questions or anything in the chat that we should address?
There was a question that disappeared, and so I don't have it exactly. But when I read it, it asked, can you have multiple long-term care plans? So do you want to touch on that real quick?
Yes, it's a great question. The answer is yes. We do have clients who have multiple long-term care policies. Maybe they bought one 5 or 10 years ago, 20 years ago, that has a benefit that just isn't sufficient. You can stack in and layer a second long-term care policy that will supplement and provide a beneficial amount of coverage. So great question. I think it came from, I see it in my chat. I do see it that it's there.
Oh, yeah, it disappeared from mine.
Okay.
Well, I will say, though, one thing to keep in mind, though, with the multiple or even just having one is that you want to be aware of the HIPAA per diem as far as the daily amount or the monthly amount, right, for long-term care to make sure that you're not getting taxed over the that amount. So I reposted it.
Yeah, it was under just the Q&A tab.
Oh, there we go. Okay. All right. Sorry, Colleen. Just, maneuvering ourselves around. So, but yeah, so yes, yes, you can. Great question.
Yes, you can. One thing I'll add on to that, the benefit of policy reviews. Clients are hesitant to have a further long-term care planning conversation because they have an old policy that they bought 15 years ago, but they don't realize that maybe those rates have changed. They don't realize that the coverage amount that they have is not sufficient. So, right, I would certainly encourage you as you talk through clients, and one of the big things that we get is that hesitation to further the planning conversation because they think they're covered, but they don't have an adequate plan in place. So really good question, and certainly something that we want to encourage you to use policy reviews for.
Definitely. All right, but that's all you got. So you're good to go.
Okay, perfect. Keep throwing those questions and those chats in there. We'll get to them. We want to make sure that you have some benefit from the conversation here. But again, we talked about common misconceptions and hurdles that we get. If you have a client, you kind of talk them through that need to plan now. You talk them through the potential downfalls of waiting. One of the things that you can incorporate into that long-term care planning conversation is an insurance product. And there's really three types of products in the industry. There's traditional long-term care insurance. And if you've done LTC in the past, or your parents or your grandparents have long-term care, they likely have one of these traditional products. They offer a lot of benefit. They are typically the cheapest out-of-pocket cost, but that's because it operates more like your car insurance than anything else. You pay your premiums over time. If you need the policy, it's there. It'll pay for the long-term care. If you don't need it, there may not be, or there typically isn't, a death benefit or any sort of cash return to you. So that traditional LTC can be a great option for those who have premium restrictions, but it operates a lot more like car insurance, closer to like a use it or lose it type of value proposition. The other type of product out there in the marketplace are the LTC riders on life insurance. So this is just typically if you have someone with a life insurance policy, they need a death benefit, you can add on an LTC rider so that if the client does need care, they can spend down their death benefit while they're alive for their long-term care. The last option is a linked benefit hybrid. These are the most popular, right, style of real long-term care planning out there right now. These are life insurance-based contracts as well, so there's a death benefit, but the main focus of these policies is long-term care. The difference between the life with the rider and the hybrid is that the life with the rider has a high death benefit, long-term care is secondary. The hybrids has high long-term care, the death benefit is secondary. So if you have those clients who want all the benefits of having a guaranteed solution, they want a death benefit, they want cash value, but long-term care is their main focus, the hybrid products are really going to resonate with that audience a lot more. And there are a lot of other benefits with those linked benefit products. So those linked benefit long-term care strategies, the biggest thing as part of this conversation is that they do allow for multi-pay premiums. So as we have the conversation around positioning long-term care in any economy, clients are certainly averse to large cash repositions when the portfolio is down. They don't want to pull out $75,000, $100,000, $150,000 to pay for some long-term care strategy. What they may be more available to doing is a multi-pay. Pay that same $100,000, but let's do that over 5 or 10 or 20 years. That allows us to lock in coverage when they're younger. The linked benefit products, what Nationwide offers, which is Care Matters, it has a guaranteed premium, and it allows them to start funding that long-term care over time. This can help you overcome all those objections around market volatility, timing and high inflation, and it helps you to address that waiting cost. Linked benefit long-term care also provides a dedicated stream of funds to pay for LTC expenses. So 15, 20 years down the road, when your client needs help, instead of calling you, they're calling the insurance carrier. Instead of pulling that $100,000, $200,000 a year out of their portfolio, they're pulling it out of a long-term care product. So by diversifying their holdings and adding in a long-term care plan, you just build in an additional dedicated stream of funds to pay for those costs. This is really how the products work. I won't spend a ton of time on this slide in and of itself. What I want to highlight, however, is that when your clients purchase long-term care, what they're purchasing is a bucket of money. Right. In this scenario, this is a $100,000 single premium, just as an example. And what that generates for this potential client, if you look to the right, is $540,000 of LTC. So if this client were to need care in the future, they have over $500,000 guaranteed that they'll be able to use for care. And because these products are guaranteed, this is true regardless of market condition. The market is up, they have that $500,000. The market is down, they still have that $500,000. This allows them to diversify their holdings and, again, have a guaranteed source of funds to pay for care. Jason, you're back?
We lost you for a sec. I lost
Okay. I thought that was I thought you had dropped out.
Yeah, we're good. You're back.
Good old
I know.
Xfinity internet. But what I was highlighting here is that, again, hybrid long-term care allows you to have a diversified holding. And in this case, $100,000 of premium, just as an example, generated this client $500,000 worth of care. And regardless of the market conditions, this is what they're going to get. The market's up, they're getting this amount. If the market is down, they're still going to get that amount. So again, incorporating a long-term care program into your client's retirement plan just helps them to future-proof, right, against some of the unknown variables that come with retirement. Again, I talked about paying over time. And if you're trying to get clients to move on a long-term care program, the best way to introduce it to them is with a multi-pay. If you have those clients who are mass affluent, 5, 10, 20, 30, $50 million clients, and they want to do a single premium, those may be very palatable. But for a lot of Americans, right, $100,000 single premium is a large investment, but $10,000 a year is a lot more affordable. So we position this as reverse dollar cost averaging. The same way that they put in money incrementally into the market, they can pull out from their portfolio incrementally to fund their long-term care program. This doesn't necessarily disturb their income stream, right? If they're still working, we're not asking them to take money out of their paycheck. We can just take a few dollars out of their account and put it into their long-term care program. This even works for monthly premiums. So I know we talked about these annual fundings, but you can do this monthly as well. And for our client, this feels a little bit more like what they may have done with their kids' retirement plan or what they're doing with their 401k. They're doing a periodic monthly contribution into that fund for later use. With reverse dollar cost averaging, we can have that same mentality and position long-term care funding very similarly to what clients are already doing with a lot of different products and a lot of different things in their retirement plan. And here's just an example of what this would look like and the power of getting your clients in young. So in this example, we had a client doing $10,000 a year in premiums, or about $833 per month, and we got them in at age 55. Over time, that is going to grow. Now, there's a long-term care benefit and a death benefit. The death benefit, that column that is labeled 142, if this client passed away, they would still get $142,000 paid out to their heirs tax-free, right? So we're still addressing that life insurance risk. But the big benefit is the long-term care. So that periodic $800 contribution, by the time the client is 85 years old, which is typically when we see claims, has grown to $1.1 million. So there is certainly a tremendous amount of economic value to getting your clients into a long-term care program as early as possible. Oh.
Looks like we lost Josh. Oh, there, you there?
Yes,
You're
popping out on my screen, so I'm not sure what.
Yeah, I don't know if it's me or you. So sorry, everybody. I apologize to you, Josh, and everybody on the call. So we'll get through this.
No worries. The tech challenges.
Yeah.
But overall, again, reverse dollar cost averaging, contributing into long-term care over time, can help you overcome the client's hurdles and can help them ensure that they have a very robust and meaningful amount of coverage down the road. And again, this is the coverage that is going to be coming from Nationwide and not their portfolio. When I think about the value to you as the advisor, if your client's 85 years old and they need care, because they have this plan in place, we know that regardless of what happens, there's $1.1 million of their retirement funds that is covered from long-term care risk. That's $1.1 million of your AUM that's covered from long-term care risk if you're an advisor working under assets under management. And this is just one person. If your client has, if you have multiple clients that need care at the same time across your book, $1 million per client adds up pretty quickly in the grand scheme of asset protection. So I just love to show this slide. It shows really the why, both for your customers and for you, and why long-term care planning can be important. There's a couple of things that I'll kind of go through here in the interest of time, but you will get access to these slides. The one thing that I'll highlight is, again, we like to show these multiple year payments as we had this conversation around long-term care. one big objection that we get, or one big question is, well, what happens if I can't pay? If I fall on hard times, the market is so down that I can't make the premiums. Well, with Nationwide offers a reduced paid up benefit, which means if your clients get a few years in and they stop paying, instead of the policy lapsing, we actually still allow them to keep the contract, but at a proportionately reduced rate. So in this example that's on the screen, a client paid 6 years out of a 10 pay, or 60% of the premiums. They get a policy worth 60% of the value if they stop paying the premiums. So very good consumer protection provision that's built into the contract. And this is guaranteed. This is no additional rider. This is no additional cost. This comes standard with Nationwide's products. And again, one of the things we talked about is the value of the death benefit. If a client passes away early, again, the long-term care linked benefit products are still life insurance. So there is a death benefit that's paid that helps, again, overcome some of those hurdles around volatility. This shows you a column of the IRR during the first 10 years of a 10 pay. So if you had a client putting in $800 per month, the rate of return on their death benefit if they passed away in that first year is 1,300%. And as we get up to year 9, that IRR is still 9%. And again, these are tax-free, right, because it's a death benefit. But as far as the economic value of securing coverage now, if something does happen to you over the next few years, you're still going to get a very good rate of return on that death benefit that makes this planning a little bit safer than what clients initially realized and allows them to secure coverage early. Before I move on much further, I'll pause again. Jason, any questions or anything in the Q&A that we should address?
Nope, not that I can see. There's working on some things. Colleen has a great question. She just asked what the premiums look like for a female age 55. So I'm going to work on getting her that. If anybody wants to see any sort of personalized illustration, just let me know.
Okay.
You're doing great, Josh.
Well, awesome. So now let's talk about, over the next 5 minutes or so before I wrap up, the cost and the consequence of not securing long-term care coverage early. Again, clients have a lot of objections. They have a lot of misunderstandings and misconceptions around LTC planning. They don't see the value in the greater retirement picture. And if your client says, you know what, I'll wait. Well, what are the consequences? First is the price increase. As you age, insurance becomes more expensive, and that's just across the board. Clients also have less time for that asset to grow. So by waiting a year or 2 or 3 or 5 before they want to do the planning, your clients are making the planning process itself more expensive for them. Inflation grows less over that time period, and health can change at any time. That's one of the big things that clients give up when they wait, is they may be giving up their insurability. You don't purchase long-term care coverage with your money, you purchase it with your health. You can have the most affluent client who has a ton of health issues and will never be able to qualify for a long-term care program from any company. So we want to make sure that while your clients are young enough and healthy enough to apply for coverage, that they're doing so without delaying. A quick point that I think is really important: the average client here at Nationwide right now is 57 years old. So for those clients aged 50 to 65, that's the prime window to be doing long-term care planning. And if someone who's 60 or even 55 years old thinks, I'm too young, well, they're not. Right in that window is the typical client that Nationwide sees. So I like to throw that in there as a bit of information. And the big thing that we ask our clients is, what's more disruptive, right? Paying for long-term care yourself during a down market, or funding a long-term care program over time. Long-term care is expensive. One of the things that we really haven't talked about is the cost of care. Now, I live here in the Philadelphia area, and the average cost of care here is about $7 to $8 grand a month if we're looking at assisted living and home health care. Facilities are a little bit closer to $14,000 if someone needs to go to a nursing home, which isn't super common, but it does happen. But again, what's more disruptive to your portfolio? Contributing $10,000 a year to a long-term care program, or maybe spending $8,000 a month to actually pay for care out of pocket yourself? A very simple question, but one that does start to drive activity and gets clients to think about what the value is in planning. Here's some quick stats around the risk of waiting when it comes to health and declines, right? Health is the biggest risk for waiting, and declines are going up, right? For your clients who are, let's say, age 60 to 64, it's about a 25% decline rate. 65 to 69, it goes up to about a 33%. And age 70 plus, it's a 50-50, right? So we want to make sure that if we can get our clients in at 63 as opposed to 70, we're saving them money, but we're also increasing their odds of being approved quite considerably. And here's a quick graph around that financial cost of waiting. So if you do have that client that says, you know what, I'm going to wait, and they're still healthy enough to get in later on, this graph shows you what the cost of actually waiting looks like. So if you're looking at that monthly LTC benefit at issue column, that's how much coverage that they're purchasing, $5,000 a month of long-term care. The monthly benefit at age 80 shows you what that grows to with an inflation factor. And then the annual premium shows you the cost. So if someone who's 55, a 55-year-old male in this example, or female, I apologize, wants to get in for coverage, it's $9,800 a year. If they waited until they were 65, that goes up to 14 grand, and their actual benefit at age 80 is only 7,700. So they're paying 5,000 more per year, and they're going to end up with about 3,000 less to actually use when they need care. So there's really no benefit to waiting. I understand that we all have things going on, but if your client wants to do long-term care planning and you think it's something important to them, there's really no benefit to waiting to secure that coverage. So I know we talked about a lot, so I'll just summarize some of the talking points that we went through. Waiting to purchase long-term care until a better time may not be the wisest decision. A better time is a moving target that we may not ever be able to hit. Self-insuring, which is really self-funding, is uninsuring. If you're paying dollar for dollar, you're not insuring anything, and you're leaving your portfolio at risk of being liquidated due to long-term care. Owning LTC coverage and doing the planning ahead of time, it removes the unknowns. We're not sure what the market's going to look like. We're not sure what health is going to look like. We're not sure what inflation is going to look like. Let's plan and take all of those variables off the table. During a down market, paying the smaller expense of LTC insurance premium will be easier. I know we say maybe, but it will be easier than paying for that longer LTC expense itself. Again, $10,000 a year premiums or $8,000 a month in actual long-term care costs. Which is going to be more destructive to the portfolio, $8,000 a month in long-term care costs. Buying now saves the age and the cost over waiting. The sooner you purchase, the more time you have for your inflation to grow. And good health today does not guarantee good health in a few months. I'll just share a quick story. We had a client who wanted to wait until after tax season. He delayed his long-term care planning conversation with the advisor. And around February, he unfortunately had an unfortunate diagnosis, which is going to preclude him from coverage indefinitely. This was a lawyer client. He had a very good retirement nest egg. He was one of those guys who are probably going to work forever. But even with him being really a prime candidate and one of the advisor's good friends, his decision to delay planning unfortunately cost him his insurability forever. So I don't want you to wait, and I want you to encourage your clients that now is the best time, and you're never healthier or younger than you are today. And now, how can Nationwide help? Nationwide has, again, a robust long-term care platform. We are one of the juggernauts in the industry, currently being number one. We've been offering long-term care for about 26 years, and we're also a very strong mutual company. And I know that in the greater conversation around the insurance landscape, private equity and hedge funds have really infiltrated the industry. And since Nationwide is a mutual company, we are really insulated from some of those moves. We don't have those earnings calls with our stockholders because we don't have them. We are a member-driven organization, and you don't have to worry about in 10, 15 years that some foreign company has purchased a large hold of Nationwide and is going to ship your client's business overseas. We just don't have that as part of our business because we believe that the customers and our members come first, and we are really here and on your side. The jingle is more than just a jingle. It's really a part of how we run our business from the top to bottom. Nationwide also has a variety of long-term care solutions. We're really focused on the linked benefit products today, but we also have long-term care riders that you can add to our index universal life policies, our VULs, our GULs, our survivorship IUL and VUL products. And we have a rider that can really fit into most of your client retirement long-term care planning conversations. Also, if you're dealing with business owner clients who want to purchase long-term care for their employees, there is some deductibility with these programs that we can discuss. So really, regardless of what your client base looks like, Nationwide has a product that can help fit that mold. Last but not least, one of the things that I'll offer as I hit this last slide is Nationwide is here to help. I know you all work with URL Group, and I know they have access to a ton of great carriers like Nationwide, but we also offer them advanced resources. We can do in-person trainings for your clients or your advisor groups. We also have advanced sales consultants, a group made of JDs and industry experts who can come out and have those greater discussions around buy-sell, premium finance, business-owned long-term care. All those more advanced concepts, we can do those for you free of charge. So Nationwide is here to help. So I'll close with just this. What's a better time than now to plan for long-term care? Regardless of what's going on in the market, we know that our clients would benefit more from purchasing long-term care and doing that planning today than waiting. And you purchase long-term care with your health, not your money. So get in while you can and be sure that you're helping your clients to future-proof their retirement plans and insulate them from the cost of care, regardless of what's happening in the economy. So with that, I went a few minutes over what I had planned. But Jason, any questions, any commentary?
No, you did a great job. Two things that I know in the conversations that I have that where Nationwide really stand out and that I want to highlight, and I know you touched on them, Josh, but it's the indemnity long-term care payout that Nationwide provides versus the reimbursement. I'd say most carriers out there are all reimbursement. Do you want to just touch on the indemnity versus reimbursement real quick feature that Nationwide offers?
Absolutely. I'd say it's our biggest feature. And all that means is at the time of claim, when your client needs help, Nationwide actually pays a cash benefit. All that means is we don't require professional care. We don't require a specific caregiver. There is no caregiving network. There's no need to get a specific caregiver or facility approved. Once your client goes to the doctor says that they need to go on claim. We start direct depositing those funds directly into your client's bank account. And that's true even if the amount of coverage that they have exceeds their expense. So if their coverage is paying them $10,000 a month, but their expense is only $8,000, we still pay you the 10. Spend the first 8 on your caregiver. The additional $2,000 can be used for other things. It can be saved, it can be invested, it can be spent on helping friends and family members. It can also be spent on things like having a maid come in and clean the house. We have a few clients that have Walmart and Amazon delivering their groceries to their door. So that indemnity style benefit allows clients to be super flexible. And unlike a reimbursement, we don't require monthly bills and receipts. So again, you're just getting a direct deposit from us each month. Spend it however you need to. It's still tax-free. It just gives the flexibility to the clients, doesn't leave it with the carrier.
Yeah, I think, to your point, Josh, I think that is something that is overlooked when people are having the conversations because, there's things that are outliers that, let's be honest, most people want to stay at their house and do home health care, at least in the initial stages. And there's things that they don't realize. The grass still needs to get cut. The snow still needs to be shoveled if you're sitting in Pennsylvania. So an indemnity plan would be able to assist them with those financial stresses that a reimbursement wouldn't even consider. So I think that is fantastic. The other thing I wanted to touch on too, if I can go back to a couple of slides here, just real quick, another fantastic feature that I don't want to miss is the residual death benefit that Nationwide offers. So most of the time, when the death benefit is reduced dollar for dollar in most products, and tell me if I'm speaking out of turn, Josh, is that eventually the death benefit will go down and exhaust itself down to zero. But with Nationwide, that's not the case, correct?
Correct.
Okay, so can you touch on the residual death benefit just real quick for me?
Yeah, absolutely. So as Jason mentioned, when you go on claim with our products, what you spend through first is your death benefit, which in this case is 180,000. If you're looking at that tan colored can on the screen, at some point, if the client has a long-term care event, that number is going to be decreased. If they spent, let's say, 100,000 in care and they passed away, they would still have 80,000 paid out to their heirs. But if they have a long-term care event, that 180,000 is going to be spent through. But what Nationwide puts in place is a floor to how low the death benefit can be decreased to. And in this case, it's 20% of that 180,000 or 36 grand. So if the client never needed care, they're going to have 180,000 death benefit. If they need a lot of care, they're still going to have at least a $36,000 death benefit, goes tax-free to their heirs. And I kind of position that in two ways. One, I think of it as a final expense policy that's built into the contract. You're able to secure your coverage, get that paid for, and your family can also have your funeral and pay for that from the contract. Some clients like to see it as a premium refund. So if you're putting in 100 grand and you're getting $36,000 back regardless, what's really the net cost of the policy? It's about $64,000 adjusted for inflation. So that residual death benefit is a huge feature in our contract. And again, it's guaranteed. There's no rider. There's no additional cost for that benefit. That comes standard on the contract.
Great. Yeah, that's great. So looks like you answered everybody's questions, Josh. So fantastic job once again. Oh, somebody just popped in here. Let's see. Oh, there you go. Colleen. Yeah, great. She says, I love the saying, you purchase LTC with your health, not your money. So true. Nationwide has given me so many nice little nuggets like that. I recommend everybody on the call today either reach out to myself and we can get you connected. Like Josh said, they've been very agent friendly as far as, being able to hit boots on the ground and help people out. So all it is a phone call to pick up, shoot us an email, and we'll be able to help you out in that respect. So don't say any other questions here, Josh. So again, you did a great job. I'll follow up with everybody with some, slide that Josh offered out and some handouts. Josh is going to send me some handouts that will white pages that we'll send out as well. So if anybody has any questions, they want to see any sort of illustrations for clients, maybe just sample ones, give me a call. My number here at URL is 717-216-8038. My email address is jasonc@urlinsgroup.com. There's no such thing as a silly question because we can't be experts at everything. And that's why Josh and I are here. So feel free to ask away. We'll be able to get clarification on absolutely anything. So everybody, thank you